last time, we learned about irrelevant proposition of the capital structure. Whether you have more than or not, it does not matter. And today we are going to learn about different approach regarding the capital structure, which is pecking order theory. So what is a pecking order? So the peck means these there are chickens here, right? So they are having pecking order. So they peck some corns when they eat, and there are orders. So in Korea and in other Asian countries, we respect elderly people a lot. So we let these elderly people eat first, and then younger people can have their spoons and their chopsticks. So this is the pecking order. So when you have a bunch of hams in your farm, there are some alpha males and alpha females. So these chicken will eat first, and then later the rest of the group will start eating the corns. So this is the pecking order. So there is some kind of order when you do something. And in the context of the capital structure, the pecking order theory means that there is an order. When a company needs some money, then it will follow this kind of order. So whenever possible, they would choose not to raise external financing. Rather, they are going to rely on their internal funds, their own cash. And then when these internal funds are not enough, then they may seek out the external financing, and in that case, they are going to start by looking for the debt issuance opportunity. And then when they have no alternatives, then they are going to rely on the equity financing. So the equity financing is the last choice of the firms. So this means if there are other choices, then the company would not choose equity financing. So the pecking order theory, basically this is about how to raise capital. And the pecking order theory teach us the lesson about the capital structure, that the capital structure at this moment is the result of the previous financing. And because of your choices for your financing, you have your current capital structure. So we have a two distinct point of view. So when we talk about the static theory of the capital structure, there is an optimal capital structure, and to achieve this optimal point, we do financing. However, in the context of this pecking order theory, we do financing as we need money, then eventually we get the capital structure at this moment. So this is just a opposing point of view about the relationship between the financing and the capital structure. So in the point of view of the static theory of the capital structure, chapter 16, the results in the ideas in this chapter determines the things that we learned in the previous chapter. However, in the pecking order theory, we do financing, and then as a result, we have the capital structure that we learned in this chapter. Then why those companies rely on the debt instead of the equity? So to understand this, we should learn about the disadvantage of relying on the equity. So in the previous chapter, I slightly mentioned about the disadvantage of equity financing, and I'm going to formalize this idea. So let's think about two imaginary firms. We have good incorporated and bad incorporated. So as the name implies, good incorporated is a good company. So as an investor, we should buy the shares of good incorporated, and we should avoid the shares of the bad incorporated. However, their names are hidden, so we don't know which one is good and which one is bad. And the problem is that these firms, both of the firms, consider equity financing because they have a good project, but they don't have enough money. So this is a table showing their current status. So currently, the good incorporated has the value of 150, and they need 100 to get investment. And once they have done the investment, they get the expected returns of 20. So the net present value of this investment is 20. So it is a good project. So it is beneficial for the company. And as a result, after the investment, the firm value will become the sum of 150, 120, so it will become 270. On the other hand, bad incorporated, the company's current value is lower than the good incorporated. It's only about 50. And it requires the same investment. And if the company does so, then it will return 10. So as a result, the company value at the end of the investment can become 50 plus 100 plus 10, which is 116. However, we cannot distinguish which one is good or bad. But as an investor, we just know their average. So what we know, these are hidden information. So what we know is that the average value of this company is 100, because the average of 150 and 50 is 100, and they require 100 investment, and once the investment is done, they get the average return of 15. So as a result, the average value of the company after the investment will become 215, which is 100, 115. So we get 215 as a result. Then let's think about their decision-making process. So if the company chooses the equity financing, then they need the money from the external investors. And as a result, we have a transaction. So company will give shares to these investors, and the investors will give the funds. And giving the shares means giving them some power. So we are giving the ownership of the companies, because the share represents the ownership of the company. And if you look at the table, after the investment, the company value will become 215 on average. However, they require external funding of 100. So 100 over 215 is coming from the external investors. So therefore, what we should provide to their investors is 46.5% ownership for the company. Then, at the same time, it means that the incumbent, the existing shareholders' ownership will shrink. So their ownership before the investment was 100% because they own the company by themselves. However, now giving up the ownership 46.5%. So therefore, the remaining ownership will become 53.5%. So this situation is called the dilution, because the dilution is a chemical process. So when you have some liquid and you put more water into the liquid, then the density of the liquid becomes lower and lower. So this is the dilution. So in terms of the ownership, the existing shareholders' ownership or the incumbent shareholders' ownership was 100. However, now it is only 53.5%, so their ownership is diluted. Then let's think from the point of view of the good incorporated shareholders. So if they decide to do the investment, they need money, so they give up 46.5% ownership, and as a result, their company value can become 270. It was only 150. So it seems that for the entire company, it is better for the company to do the investment. However, the problem is when they do so, only 53.5% is for the shareholders. So what they get is only $144 million. And actually, this is even worse compared to the situation that they just give up the investment and they do not get the financing from the external investors. So when they give up the investment, they do not get the funds and the company's value is smaller, so they have only 150. However, their ownership is not diluted, so they can have 150, which is better than the previous case. So therefore, in case of the good incorporated, for the existing shareholders, it is better just to give up the investment and do not get the equity financing. On the other hand, for the bad incorporated, the situation is reversed. So if they choose the investment, previously before the investment, their company value was 50. However, now it can become 160. So therefore, even if you think about the dilution, even if they get only the 53.5% as the return, what they get is 53.5% of the 160, which is $85 million. And this is obviously better than doing nothing. So if they choose to do nothing, their company value is only 50. So even if they get the entire value, they have only 50. However, if they give up the shares, if they give up some of the ownership, and if they choose to be diluted, so what they get can be increased to $85 million. So therefore, for the bad incorporated shareholders, it is better to raise external financing and to experience the dilution. So the two different companies have two different choices. One company give up the financing and the other company chooses and accept the financing. And which one accepted the financing? The bad incorporated. So therefore, as investors, even though we do not know the name, even the name information is hidden, we can verify, we can identify which one is which one. So we can see that if any of two firms raise external financing, it should be the bad incorporated. On the other hand, the other one that gave up the investment and just staying at this moment is the Good Incorporated. And the differences between two firms is this one. So Good Incorporated is already doing good. So therefore, they don't have to experience the delusion. So they don't want it because they are doing well. On the other hand, for the Bad Incorporated, the only way they can increase their firm value is to accept the external shareholders. So they gave up their ownership, and by doing so, they can become larger company. So in reality, some companies choose to have equity financing, and it means that they are giving up the shares, they are giving up the ownership. So therefore, that there could be some reasons why they are taking this disadvantage. So what we can say is that actually they are doing this because they are in more difficult situations than the other. So usually the seasoned equity financing is bad, and whenever a company announces a seasoned equity offering, the stock prices declines. The reason is because now investors see that the company is in a difficult position. So they are internally, they know that they are bad. They are worse companies than the others. So their stock price is higher than they are expected. So after they announce the seasoned equity offering, now everyone knows that maybe they are going to have some bankruptcy issues, or maybe they don't have enough money, or they are having some legal disputes, or maybe something bad is happening. So that should be the reason why they are providing the ownership of their companies voluntarily. So therefore, now the investors perceive that, and the stock price goes down. So a seasoned equity offering usually results in a decrease in the stock price, and this was their last choice. So there was no other option, so that should be the reason why they are doing this. So frankly speaking, so this can be understood in a very simple situations. So you are walking on the street and someone came up and someone is trying to give you some food, and you do not trust him. You usually suspect what is inside of the food, and there must be some poison or something. So that's the same idea. When these shareholders are providing their shares, even though they know that they are going to have the delusion, it means these shares are not that good. So this is like providing some poisoned apples to the Snow White. So you should be more skeptical when they say that they are going to provide you something good. So when these companies are doing the equity financing, it means their company's equity value is not that high. And second, therefore, we should prefer debt financing rather than relying on the equity financing. And how about the debt financing? So if they are having enough money, then they don't need the external financing from the beginning. So therefore, companies that are borrowing from others again and again, that means they have some problems. So usually what we see is that firms with less debt are more profitable, and actually this is the reverse causality. So it seems like the action was the firms with less debt, So this was the reason, and this one looks like the outcome. However, actually, because they are profitable, they don't need extra money. So the situation is reversed. So they have sufficient cash, and then they don't need the extra money from the banks or any other investors. So that's what the pecking order suggests. And again, whenever the company has enough money, they don't have to borrow from others. When they need to get some financing from somewhere else, they should choose the debt financing. And finally, when they have no choices, then they can have the equity financing. However, because the equity financing is bad, the shareholders and the investors will realize that the company is in poor situation. So let's compare the pecking order theory and the static theory of the capital structure. So first, the static theory of the capital structure suggests that the managers of the company should care about the capital structure, and there exists certain optimal capital structure. And usually they target this, so in the long run, they try to achieve this capital structure. So the static theory of the capital structure is helpful in explaining the long-run strategies in their capital decision. On the other hand, pecking order theory this approach is totally different. So they suggest that the capital structure is the result of their financing repeated times, and it tries to explain at this moment what they should do when they need some money. So they provide certain pecking order in the capital structure, and they suggest that whenever possible, that financing should be preferred compared to the equity financing. So it is more helpful in explaining short-run tactics in financing. So these two theories are complementary to each other. So in the long run, the managers will decide about their optimal capital structure based on the static theory. But at the same time, for the short-term financing, they would consider the pecking order. So they would choose the debt compared to the equity.